and welcome to the Wall Street Blockchain Alliance's latest episode number 2 of Understanding the WSBA Crypto Industry Principles. My name is Quaranta, chair of the WSBA, and I'm very proud to be here with dear friends and colleagues and part of the core team of folks who helped us create the WSBA Crypto Industry Principles. We'll do a quick series of introductions, but before we do that, my usual disclaimer, as you all know, please do keep in mind that nothing discussed is accounting, investment, legal, or tax advice. I want to go around the horn a bit and have everyone say hello. David, please say hello and tell us who you are.
Hey, thanks, Ron. My name is David Wysoki. I've been an attorney in New York City for about 40 years, focused on traditional finance, commercial transactions, and securities, and currently work as one of the co-chairs for the tokenization working group of the WSBA.
David, thanks so much. Jess, want to introduce yourself again?
Sure. I'm Jess Stumacher. I'm an attorney. I'm also an attorney in the space. Not quite as much experience, but I've been in the space since 2014. I'm primarily as a regulatory enforcement attorney, focusing on the digital asset space.
Jess, thanks so much. Stephen, this is your first time at our Industry Principles. Please say hello.
Hi, I'm Stephen Rutenberg. I am the co-head of the blockchain and fintech practice at Polsinelli. We are about 1,000 lawyer law firm throughout the United States, and happy to be involved in this important initiative.
Stephen, thanks for joining. David, I want to start with you. We started last week's episode with kind of this overarching, let's talk about the general principles, which was essentially the first foundational segment of the overarching principles that we created. What are some of the takeaway thoughts on general principles? And I want to give Stephen and Jessica the opportunity to do that as well. But what were your thoughts on the general principles?
Sure. It was fairly straightforward and fairly simple. We believe that platforms and participants in the digital space should strive to work in good faith and to align expectations of their consumers, customers, end users with the opportunities. Avoid unnecessary complexity and confusion. Clearly don't front run on trades if it's a trading platform. Disclose conflicts, economics, financing, and risks. Don't hide the ball, right? Make conduct clear, transparent, and seamless as the technology purports to provide on the operational end. And I guess lastly, provide a path for redress when things go wrong. As much as we'd like to believe everything's going to be perfect, there's always something that drops off the edge. And so just make sure that people have a way to complain and a way to achieve economic redress.
David, thanks so much. Stephen, Jess, I wanted to pull you into that as well. You were all with us at the beginning of the conversations around crafting the principles. And the general principles, the mindset we all had was almost essentially venue agnostic, regulation agnostic. Basically, if you're in this space, behave this way because it's good for the space and good for you as well. Jess, I want to start with you on this, and then Stephen, give you an opportunity to weigh in as well. Did you see it that way? What were your perspectives on why general principles of almost behavior were important as part of the ecosystem?
Yeah, absolutely. I saw it that way, and I'll echo everything that David just said. I think that, a principles-based approach, especially in the absence of regulation or meaningful regulation and sort of a lot of uncertainty has never been more important.
Jess, thanks. Stephen, your perspectives, and I want to add one thing to that as well. It's interesting. Jess, you said something I'm going to push back a little bit on, because you said in the absence of meaningful regulation, which I get it, and many of us agree with you. Many others don't, but I think that's almost not the particular issue when we're talking about general principles. Stephen, what were your thoughts on kind of those foundational principles?
Definitely, I agree with everything David and Jess said, but I'll kind of take it a step further. I think part of the idea of blockchain, at least in concept in DeFi, is that it's supposed to not need central authority, and the blockchain itself is based around the idea that it is, and actually is, doesn't fit well into borders. I mean, whether we see people doing things offshore, trying to take advantage offshore, both for good and bad reasons. And I think the idea, and a lot of what drives us to this space, is the idea is, can you build finance as a community? And if you're going to build finance as a community, the primary thing is you have to trust the network, and you have to trust the community. And frankly, that's not something this industry put first. Development. Time to go back to the principles of principles and be DeFi in regulation. If governments want to regulate, they can. That's separate from this. I mean, I think one principle is follow regulation, but the more important principle is what are we in an industry and what are we trying to do?
Stephen, thanks. I want to stay with you for a second and open it up to the rest of the group if I could. And I think one of the points that we hit there regularly, there's this common refrain in, I don't want to use the phrase mainstream media, but I guess I just did, that all crypto's bad. Generally, it's meant for illicit activity. And the idea that, move fast and break things from a technology perspective, moved into the crypto world, and that meant everything was supposed to be illicit activity. I would argue, and Stephen, tell me if you agree, that for a long time there have been principled participants in this space trying to do the right thing in the absence of just what you mentioned a bit earlier, which were relevant regulations or applicable regulations. Stephen, do you agree with that, that not everyone in crypto and blockchain is, trying to circumvent paying taxes or an illicit operator?
I mean, certainly. I mean, I think all of the four of us on this phone, on this call,
At a minimum,
have always been have been principled. And I know myself, and I know David and Jess have turned away many clients in the space, primarily a few years ago when they weren't following principles. And I have to say, I've just found from the potential clients that come to us, I think the space has gotten much more principled already. I think some of it we're codifying what I think everyone should have been doing, and I think many more people are doing. The players in the industry I've been seeing over the last 2 years have been much more straightforward and principle based. And yes, the vast majority, but it doesn't take that many bad apples to ruin it. And we've had, I would argue, more than our share of bad apples.
Stephen, fair point. Jess and David, I want to ask you about this as well. It's funny, Stephen, as you expressed that, one of the conversations we've had with colleagues, and we do our own events, other industry participants do events on a regular basis around the globe. And one of the refrains we've heard for a good chunk of this year has been, oh, look, there's grown-ups from TradFi at these events. And I wonder if that's a bit of a reflection of the maturity of the industry and the enablement of principles. But again, I want to, David and Jess, offer you the same question. Are you also seeing that evolution, that there are principled actors in this space trying to understand how it evolves?
I think there always were, and I think that one of the problems that we've encountered the last 2 years is that, we've gotten overwhelmed by bad actors and bad facts. And that doesn't undermine the activities and platforms by individuals that are more circumspect and are thinking about their consumers, not just their investors. There was, the promise of crypto is that it didn't always live up to its promotion, right? Crypto is transformative. It was egalitarian. It's supposed to be democratic. There was always a libertarian appeal that followed the industry. You get to thumb your nose at TradFi and all of the traditional interlopers, quote unquote. And then crypto shit the bed. I'm sorry for the language, but we've now seen what happens when you believe that everything always just goes up and you don't have to worry. And who got hurt in that? Retail got hurt in that. That's the focus of our discussion today. The early adopters, the true adherents, the people who could at least afford the risk of a speculative bubble that was in fact engineered by forces and participants in the ecosystem that overwhelmed the VCs, overwhelmed funders, overwhelmed their boards, overwhelmed regulators, and got to the point where even regulatory bodies in the United States got probably a little too close to some of the participants in the industry with funding and political donations. So it's not a surprise that we're now, hopefully we bled out the most speculative elements, the worst elements in the industry, and we're now seeing a more mature and more truly egalitarian assessment being applied in both projects that get funded and projects that are advancing.
David, thanks. I'm going to play a bit of devil's advocate here, and I'm hoping that Jess backs me up. And yes, once again, I'm tearing up the script, Jess. But to the points, David, that you just made, whatting the bed, I get it. But I would argue that some of the biggest collapses that we've seen and the biggest negative reporting that we've seen, if you took the word crypto or took crypto out of that equation as a catalyst, that would have happened anyway. In other words, some of the implications and allegations of fraud, for example, had nothing to do with crypto. Jess, do you see it the same way, or what's your perspective on how this has evolved? Have we bled out the bad actors?
Have we bled out the bad actors? I mean, I don't think you could ever really bleed out all the bad actors in any industry. So I think, I think what you were alluding to is whether it's, crypto is really the attraction for bad actors. And I would say absolutely not. I think, where there's, a means, there's always going to be someone in there who's acting not in line with everyone else, or not in line with a certain, moral code.
Go ahead, Stephen.
And, yeah, I don't see this being primarily, look, bad actors is part of it, and I think part of it is screening out bad actors. But another part of it is, which really doesn't relate that much to bad actors, is dealing with customers and consumers in a different way. I mean, the U.S., somewhat of an overgeneralization, but the U.S. securities laws were really made to protect investors and customers. I mean, that was one of its core principles from its start, more than I think in other countries. And I've heard anecdotally, though don't quote me on this or that, the SEC felt compelled to get involved in the ICO space because it was being marketed to consumers. I would argue that if ICOs were being sold the way they're kind of sold now, primarily to accredited investors, the SEC never would have gotten involved. I don't know if today's SEC would have gotten involved there, but the SEC of 4 years ago probably would not have gotten involved. I mean, when you're dealing with customers, I mean, I would almost compare this to the loan market, which is a market I'm pretty involved with, where it has an industry code of conduct. And I don't believe this is actually in the formal industry code of conduct, but people don't trade loans with customers. I mean, it's all with accredited investors and all with funds, basically, and mostly quibs. And therefore, the SEC has basically stayed out of the syndicated loan market, even though for the last 30 years, whether that continues, again, there's another question, but it may not. But it's things like that. It's not only just dealing with bad actors, it's setting up parameters of how to be trusted, how there's certain risks that may make sense. For example, if you're buying crypto, that's a risky investment, but your network shouldn't be risky. I mean, the risks that you're allowed to take, you should be allowed to take on a crypto should not be the same risk that a network or an exchange should be allowed to take.
Right. Stephen, thanks. And a shout out to you for, I know you're in Europe right now. You're so dedicated to the principles that you're joining us live, so I'm grateful for that. You also neatly queued us up for the second section of the WSBA Crypto Industry Principles, which, Jess, if I recall, you spearheaded. We just lost your camera, Jess. You spearheaded, which was customer rights. And we've all had very deep conversations, and we've all contributed to the various portions of the crypto industry principles. But Jess, you were pretty passionate about customer rights. I remember in our early conversations, I want to say it was January or February of this year, and you noted something that really stood out to me, and I'd love you to talk about it, expound upon it a little bit, which was full, fair, and transparent terms as a customer right itself. And a lot of folks in the industry would push back and say, well, our terms and conditions are on the website, and really not particularly addressing what I think you're addressing here and what we have all agreed to from a principles perspective. What are your thoughts on what full, fair, and transparent means from customer rights perspective?
I think, sure, thanks, Ryan. I think just generally, having one set of terms and policies and procedures for all customers is not really serving your customer base. I think, as David mentioned, retail investors are sort of a special class of customer. and treating them sort of the same as your accredited investors, as your hedge fund, as your, large institutional, financial institutional type investors. I think that, in a lot of ways, you're sort of taking advantage of customers, or you're sort of not really explaining, and the customer doesn't really know what types of products they're getting into, and therefore they're not necessarily consenting to participating in the types of agreements or loans, or even purchasing of assets. And so I think that it's extremely important that there's sort of a set of terms and policies and procedures that's in plain English, where you don't have to be a seasoned investor to really understand the products, the platforms, what you're investing in. And I think that there's sort of been a real dearth of that throughout the industry. We saw that a lot with the collapse of FTX and subsequent, and even prior to that. But with the bankruptcies, where plenty of customers didn't really understand the terms of what they were agreeing to, and they deposited funds with CFI lenders. So I think that sort of remediating that going forward would be really important.
Jess, I want to go ahead, David, please.
Oh, I apologize. I think one thing to keep in mind is, Stephen was right in saying that it's not just a function of bad actors. We should recognize that the technology is so omnipotent. It allows participants to engage in conduct that always involved intermediaries, a third party that was supposed to do the scut work, right? The checking, the benchmarking, making sure it was safe and sound and transparent, and did the AML KYCs and made sure that there were, if it were a security, at least they would have certain protections and rights and duties to oversee suitability. There would be advertising disclosures, marketing disclosures. There would be a complaint function, recourse mechanisms. All of those things that the traditional financial market has built for 90 years was upended by the power of the technology. And so what we're suggesting, and one of the reasons why I think Jess was so spot on in highlighting consumer rights as a preeminent fundamental principle, was that we need to figure out a way to restore that balance. Remember, the retail market is the part that is the butt of the information asymmetry. The institutional investors, the platform participants, the traders, they know things that the end user doesn't. We're the rump, right? We were the dumb money, and that's always the role. That often is the role of retail.
You're not filtering today, David.
In financial product innovation, we know that we've all worked on trading floors. And we know who we would market the most riskiest aspect of certain financial products going back for 20, 30 years, whether or not they were mortgage related or crypto related. And so this is just one of those aspects. And what I think we're trying to suggest is that we need to have individual platforms and producers and developers and the boards and funders suggest that their institutions take on the responsibility for protecting the retail community that is the core part of their base.
David, can I push on that a little bit? And Stephen, I'd love you to weigh in here as well. You said something interesting, and we've always heard the phrase dumb money, and we understand what that means. And we really couldn't argue with the perspective that there was a lot of speculative fever, particularly from retail, particularly during the meme stock craze. If we're talking about things like disclosures or the elaboration of customer rights, bluntly, would they have paid attention to it? And the example we have, right, David, you and I joke about this, but if you're a retail options trader, you get a very big Options Clearing Corp disclosure document that I would argue most people wouldn't understand. And I'm not necessarily mocking that at all. I think those disclosures are important. But Stephen, David, Jess, would people have paid attention even if there were those disclosures? This is another ripping up the script question. You can all avoid it if you want to.
Look, go ahead, Steve.
Oh.
Apologies, please.
No, I mean, I think it's a good question, but I think that's why I think disclosures are important. and documents are important. And in the height of the ICO boom, I had an investor who came or a company founder who wanted to do an ICO. And I was like, why don't you just sell this to accredited investors? And his comment was, well, accredited investors need documents. And I'm like, get out of here. You're not trying to democratize the market.
Yeah.
You're not trying to open the market to Aunt Sally. You're trying to screw over Aunt Sally.
Yeah.
And I think that's part of it. Another part of it is, I think, and this is probably a deeper part of the principles, is we need to have an industry set up that there are built-in protections for customers, meaning customers could lose their investment. If you're investing in the space, you could lose your investment, but you shouldn't lose your network. Like you could fly somewhere and like drop dead on the plane, but as a country, we don't let planes crash. I mean, there are certain risks we allow. I mean, we let you eat a cheeseburger and smoke and like drop dead on the plane from that. We don't let planes crash. We'll shut down a whole airline if we think a plane might crash. We need to have that. That's really the goal here, is that we can't have our networks crash. I mean, we have to have we can't have the FTX type situation. We can't have that level of fraud.
Stephen, thanks. Jess, do you want to weigh in? Go ahead, David. I apologize.
No, please. Yes, please.
Go ahead.
So, you asked the question, would people have read the disclosures if it was available? I think we just got to take the view that information is valuable, and it gets filters and it gets digested. I agree with you. If you read the boilerplate options trading disclosure pamphlet, it's mind-numbing. No one will read that.
All due respect to OCC.
But I do think it would be extremely beneficial if people understand the nature of the risks that they're taking and the nature of the relationship. One of the fundamental things that was misunderstood, certainly by the retail community, was the nature of the relationship between themselves and the platforms. They viewed it, rightfully so. They were told it had the look and feel of a deposit. I give you my crypto, you hold it in an account. I earn interest on it, right? So everything was just at a very high level, making an end user think, I have a bank account, or, even though it wasn't called a bank account, even though it wasn't a bank, and even though it wasn't currency, it was crypto. So I think one of the things that people were allowed to, no one intentionally misled them, but clearly no one told them the truth. And the truth was that, as they later found out in bankruptcies, that they were all unsecured creditors of those institutions, especially when they engaged in staking opportunities and effectively gave permission to platforms to lend their crypto out to third parties, VCs, hedge funds, traders, and others in order to, or possibly liquidity pools, and thereby earn a yield. And, I think, the economics of those transactions ultimately were that, the traders made money, the VCs made money, hedge funds made money, staking liquidity pool participants may have made money. And as long as everything was going up, everybody made money, including the depositors.
Sure.
But when it went down, that's where the asymmetry was, right? 100% losses to the account holders, right? And I think that lack of information, people did not recognize that it was an unsecured credit relationship, and they effectively were lending their hard-earned crypto to a third party who they had no knowledge of, information about, or information to do a reasonable risk assessment. Am I getting enough? Is 4%, 8%, 12% yield worth it, or should it be 400%? And so I think that asymmetry, that structural asymmetry, is what we're talking about when we think about disclosures, not just the boilerplate.
Yeah, and when you look at a marketplace that is offering double or triple digit percentage returns on an annualized basis, and retail folks who are saving money at a bank are well sub 1%. You can see the allure, but in the interests of full and fair debate on it, the SEC has flagged this as well. These kind of marketing of, unrealistic returns. In Europe, I think, if I recall correctly, David or Stephen, correct me if I'm wrong, there was recently proposed rulemaking around the marketing of crypto assets that I think, David, ties into this a bit. Stephen, I want to come back to you. I'd love to focus a little bit on the bankruptcy stuff. We had the privilege to work with you on a session earlier this year on bankruptcy claims in the crypto space and kind of both the challenges there and the secondary market there. Speak to us a little bit on something that I think most retail folks won't understand, that David, you alluded to, unsecured creditors. And one of the interesting things we've seen is when there's been a crypto bankruptcy, a whole bunch of folks who are not lawyers, not bankers, not accountants will come to us and say, wait, I'm an unsecured creditor. What does that mean? I thought I was a customer. I want my crypto. How did that evolve, Stephen?
Well, I mean, I think we have to separate from something like Celsius, where most people had lent money at a pretty high rate of interest, and they were clearly money was going somewhere, and I think customers clearly should have known that this money wasn't being held in a bank account for them. And in that case, they would be a regular creditor without necessarily having security behind it. I mean, I think you could have been three things. If you put money into a Celsius account, let's just say there, you could argue that you should be a secured creditor, meaning because if you deposited your crypto there, then that crypto you should have a security interest in that crypto. Or, as many people felt, they should be even more than that, and their crypto was actually theirs. I think a huge number of people who put money into Celsius felt that not only should they have been a secured creditor, they should have been it was just a custody relationship. And I think Celsius probably gave some people the impression that was the case. And I think people should have. I mean, which why I think this is complicated. I think people should have known better, and they're sophisticated customers who should have known better. But, and the reason I believe these principles are so important is that even if they should have known better, if we believe in this industry, we all walked by and heard them talking about this and knew this wasn't a realistic return. Is this what we want to be the bedrock of what we hope is like a new portion of the financial system? I mean, we need to, if we really we all should have, and maybe we all could have, and we all did a little bit, should have done something to stop this. I mean, if this is the industry that we really believe is important, and there's so many advantages of it, there was a lot of people who maybe they weren't fraudulent, but were kind of at the edge of it. And I think if we're going to move forward, we need to be. Doesn't mean there's no risk, but for many things, we need to kind of be whiter than snow, not the sketchy side of the market.
How much of that was ignorance, though, Stephen? And I don't, again, mean to play devil's advocate on this, but when you look at and I'm not negating allegations of fraud and the other things we've seen in some of these industry collapses, but when you look at executive management, the composition of those groups, no banking experience, very little legal experience, very little financial markets experience. That's changed, particularly as some of these come out of bankruptcy. But is it too simple to say, well, they just didn't know?
Who's they?
These platform providers who are offering double and triple digit annual percentage returns on crypto holdings and deposits and didn't disclose the way they probably should have.
I think I believe, look, this is a question that's going to be litigated, at least with Celsius. So I don't know, but I think they were, but I hate to use the word they, but I think there is, in many of these things, there is a they who could have known. Maybe in the case of FTX, where I think there was probably no way for consumers to have known, and probably to have known something was going on, and probably not even a way that their lawyers could have. and this is not illegal, this is not based on anything else. Whoever invested $150 million could have done that and could have seen that, let's say, for example, with FTX, if you're investing a significant amount of money there, or you're even one of their lawyers, and you see that they're trading with an affiliate, you're like, no, this is something you shouldn't be doing. There is some they, and it won't be always everyone who could raise these and say, no, we're not going to deal with this for this industry with people doing this and acting in this way. And I think one of the beauties of this is that I don't think these are hard and fast rules, and it's not everyone's responsibility to always bring it up. But if it's something in our mind, and we'll all end up more successful if we try to stop these things, and we keep on the outlook for it.
Stephen, it's interesting that you raised that in conversations with friends who are I've had that are not crypto related, don't want to be. The conversation generally ends up being, well, what about just overarching business ethics? And it really struck me that if you're just going to be an ethical business person, there are some things you just shouldn't have done. Commingling customer funds, for example, was one of them. Jess, I want to pull you back into the conversation because, again, you really started off the customer rights section. We're really grateful. Before I do that, to Stephen's earlier point, nothing is accounting, investment, legal, or tax advice, folks. Please do keep that in mind. And if you're watching live on LinkedIn Live, thank you so much for joining us. Please post your questions for the panel in the chat. We'll address them as soon as we can as well. Just one of the things that you spoke to, and I want to ask what you meant by it, were clearly defined and unalienable rights. And as a non-attorney, when I read that, it struck me that different platforms, different organizations might be, or service providers might be speaking to what they consider to be rights, but they may not be the same, or they may not be clearly defined, or what you called unalienable. Pardon me, can you speak to us a little bit about why that was important, what you meant by that?
Sure. I think sort of when you're considering that you're dealing with, unequal actors of unequal power or sophistication, you generally have, when you think of the retail customer, they're, generally less sophisticated, less knowledgeable, and, in a position that they're not able to as well assess risk as presumably, a sophisticated non-retail entities such as, the lender or a CFI platform, just to keep in the pattern of what we were discussing. I think sort of laying out and sort of, delineating exactly what sort of rights you have as a customer when I'm, engaging in a transaction with a more sophisticated party, or rather when a retail customer is engaging in a transaction with a more sophisticated party. It's really important for them to sort of know, this is how I can terminate the agreement. This is how I can walk away. Where I think in a lot of, especially in the bankruptcy examples, I don't think it was so clear, even when there were sort of runs on certain platforms, how do I get my money out? Am I allowed to get my money out? What sorts of rights I have? Can I sue if they don't respond? And I think that, that wasn't clear. And I think that was sort of a pattern across all of these situations where, customers really were scratching their head. Am I a depositor? Am I, did I lend money? Am I a secured creditor? And I think, having these sorts of rights spelled out in plain English for every retail participant is really important, and sort of knowing, in the instance of XYZ, here's what I'm allowed to do, and the company can't change its mind or sort of amend the rules and change the game on me.
Just thanks. I want to hang on to that because you said something interesting, and David, I'd love your thoughts on this and the groups as well. You mentioned terminating a customer relationship. The living example for me is I can go to my cable provider online and add any channel that I want for obviously a fee. If I wanted to close that account, I need to fill out several forms and call customer service with a 4-hour wait. Why? Why is terminating an account so difficult? And I understand that this goes across multiple industry verticals, but why is that so critical and important in the crypto space? David or Stephen, do you have thoughts on that?
Stephen, I'll punt it to you.
No, you can go first, David.
Look, so I think there's a theme throughout all of these questions, right? It's fundamentally customers did not benefit from the rights and protections that they expected to have, and that exists in regulated financial services. And I think that's the real break, right? We thought that we could escape what has been built for 90 years. And effectively, the crypto community designed elements of a financial system that unfortunately had some of the worst of elements of our financial history. Some of that had been eliminated or constrained by regulatory constraints in traditional finance. And unfortunately, a lot of the conduct in crypto fell outside of the purview. And so people were left dealing with some common law principles. I think that one of the things that I did want to mention is just an experience that I had as a mentor and advisor to many first generation students at City College in Holland. These are economics and computer students for the most part. And I've been working with them for years. And one that struck me as odd as anything was that they all traded crypto. They didn't have bank accounts, but they traded crypto, and they all knew about it, and they all were playing in it for years. And I think there's an element that we should appreciate and understand, that crypto use in some respects is just driven by some less rational motivations, right? The advertisements for crypto, the way it really did target youth, right? The celebrity endorsements was designed specifically to get people from an age cohort that was going to be less aware, less sophisticated, less engaged. And they were also using and exploiting, certain sentiments that existed, such as, FOMO, fear of missing out, and the lure of the glamour that it was associated with some of the aspects of the celebrity endorsements, as well as the notion of easy money, to the moon, right? Minting millionaires over a weekend. And combined with the, some disillusionment, maybe mistrust even, with traditional financial services, some of which is probably very well, a reasonable reaction. But I think all of those elements also contributed to the unfortunate, it's like individuals were led into a market, were allowed to participate in a market, and no one stuck up their hand and said, you're going down the wrong path. No one in the community, no one among their friends, no one within the support functions that were involved in those transactions. So I think part of that is what we now see. We're now looking at this as how do you reignite a degree of protection and stability for those who are at the bottom end of the information asymmetry. And I think that to me is why the focus on consumer protection has been one of the fundamental principles of the WSBA.
David, thank you. Stephen, Jess, let's expand that question out a little bit. David, you said a couple of interesting things there. When we, the membership of the WSBA, I often joke, is not crypto anarchists. No one's looking to burn down the Fed. It is crypto native companies. But it is also
just the SEC, right?
What's that?
That was a joke. I said if we were going to burn down any building in Washington, it would be the Fed.
I just want to point out for the audience watching this, that everyone's opinions are their personal opinions being expressed here and do not represent the opinions of the WSBA or their member firms. Thank you, Stephen. I want to digress a little bit, Stephen, and it's a great point. You said something, David, interesting. And when we look at the principles and we look at the members of the WSBA, they are banks, there are brokerage firms, there are institutional investors. And often the conversations that we've had with them have been, these principles align in many ways with the things that we do and how we've been operating our businesses. And we've seen in the news recently, this is all public information. BlackRock, Larry Fink, I believe, recently noted that Bitcoin, could be a hedge. Probably paraphrasing that. So there's this perspective, Stephen and Jess, is it TradFi to the rescue? And will that be what kind of propagates these principles out more completely to the ecosystem? What are your thoughts about TradFi in crypto? Stephen, you want to kick us off?
Sure. I mean, when it comes to these principles, I don't think it's necessarily relevant. I mean, I don't think TradFi has the best record of protecting consumers either. I mean, let's not kid ourselves. I mean, plenty of the biggest institutions. I mean, one of the drivers of crypto, ironically, is the Satoshi launched the Bitcoin white paper right when Lehman collapsed. Whether or not there was fraud there, but is again a question. But there were TradFi is not necessarily the model for protecting consumers. If they help do that, it is important. I mean, I think we really, the goal here, or at least the goal was, to be better and to show that as a community we can follow principles. I mean, at some point, maybe this will be able to be built into code, though I don't believe it ever will. But until that time, we have to be DeFi as a community. And I'm not talking about being big brothers and looking over other people's shoulders, but there are plenty of times in which you're doing a deal, but you're following the ethical rules. But look at the person you're investing in. I mean, don't take an extra look that they're following the rules, and that they're following these principles. I mean, whether it's legal or not. I mean, are they putting too much risks on customers, even if it's being disclosed? I think one of the things that FTX shows is that the Silicon Valley firms do a really bad job of diligence sometimes. I mean, don't do a better job. Do a better job of diligence, and particularly, in my view, would be try when possible not to deal with customers. I mean, try to take money from institutional investors. One of the things about crypto, some of it is we're convincing ourselves of this, some of it's true, is we want to build a token ecosystem. You do need to have customers involved. This is a little bit different than other industries, like, let's say, much of other hedge fund finance and so on, which is no reason for customers to be involved. Here, you do want broad adoption. So there is reasons for customers to be involved here that you might not have in other areas of finance, and customers will lose their money, but do extra diligence and look, even if you're not doing anything wrong, if the company you're investing has numbers that look too soon, be the adult, be the one that the customer doesn't. I mean, don't get intimidated. I mean, I had a conversation with one of the executives of one of these years ago at a conference. And I'm like, I don't understand your return. And he's like, well, that's because you don't understand crypto.
Oh. Yeah, of course. David, Stephen, thank you so much. Jess, we've only got a couple of minutes. Do you want to weigh in there, and then we'll prep up for next week's episode as well? I mean, customer rights really were one of the foundational stones of what we tried to put forward as far as the WSBA Crypto Industry Principles. Yeah, and I know you have been active in the space. You understand it at a level that many people don't. But just kind of wrap us up around customer rights and how that can evolve going forward.
Yeah, sure. So I just think generally, I mean, the more rights we give customers and the more we sort of hand them down to them, that they understand them, I think the less that the industry and the space itself is sort of going to be known for its lapses. I think, when we see sort of these crises occur going forward, and you see customers who are aware of sort of, how it will play out and how to sort of mitigate their risks in these instances, I think we'll see a lot more of sort of the general public embracing the industry and sort of respecting it and it'll legitimize it to some degree to those who sort of think this is still a crank space. But I think, sort of spelling out those rights and protecting customers going forward is probably, one of the most important things to sort of the longevity of this industry and growth.
It's just good business, no matter the industry vertical, in my opinion.
Agree. Absolutely.
David, Stephen, Jess, we're going to leave it there. There's lots going on in this space. Next week, we'll go even further down the rabbit hole. We will deep dive on collateral management. But again, for those of you watching, thank you for joining us. We'll also have the recording available on LinkedIn and on our YouTube channel. If you have additional questions about the principles, you can find the link directly on our homepage, WSBA.co. And if you want to ask any of our panelists questions directly, email us info@wsba.co. You will be seeing Stephen, Jess, and David again in the future. But all three of you, thank you so much. Really gratefully for your time and your effort.
Thank you.
Yeah.
Take care, everyone.